You open up it at 3 in the morning. Your thumb hovers over the glowing red order button. You just placed a 20 times leverage trade on an obscure altcoin you heard about in an anonymous Telegram group. Your heart is hammering against your ribs. You check your bank account balance. You close the app. That moment has a name. Behavioral economists call it variable reward conditioning. Psychologists call it financial dissociation. In South Korea, where millions of young adults trade digital tokens long past midnight, it is quietly rewriting an entire generation's relationship with money, risk, and hope. This is not an isolated obsession. According to reports from the Korean Financial Services Commission, young adults under 34 account for over 60% of all active cryptocurrency trading accounts across major Korean exchanges. Millions of young Koreans hold active speculative accounts. Why are millions of young people in one of the most technologically advanced nations on earth treating their life savings like a late-night casino bet? To understand this, you have to understand a word that haunts modern Korean youth, byeorak-geoji. It translates literally to overnight beggar. It describes the psychological panic of staying financially responsible, saving your salary, working overtime, avoiding debt, while watching housing prices and stock markets explode around you. You did everything right. Yet, relative to everyone else, you woke up broke. When traditional paths to upward mobility feel mathematically impossible, high-risk speculation stops looking like a reckless gamble. It begins to look like the only remaining exit door. Let's walk through a week in the life of a 27-year-old office worker in Seoul. You wake up at 6:30 in the morning in a small studio apartment. You ride a crowded subway car where almost every person around you is staring at a smartphone screen filled with red and green price charts. You arrive at your desk. You work 10 hours a day for a salary that barely keeps pace with monthly inflation. You calculate how long it would take to buy a modest apartment in Seoul on your current income. The answer is 49 years of saving every single one. Then you check your Kakao Talk group chat. A former classmate posts a screenshot of a 400% return on a speculative coin. A coworker mentions offhandedly that they made 2 years of your salary in a single weekend. Your brain registers a sudden spike of cortisol and dopamine. The noise of your daily routine grows unbearable. Your salary suddenly feels like a slow pay cut. This is where Bitu enters your life. That is the Korean portmanteau of bit, meaning debt, and tuja, meaning investment. It describes borrowing money specifically to invest in volatile assets. Data from the Korea Credit Bureau reveals that young borrowers under 30 accounted for the fastest growing segment of unsecured personal loans and credit line drawdowns during recent trading surges. You take out a personal loan. You transfer the funds directly into your exchange wallet. Why does your brain accept this extreme level of risk? Sociologist Byung-Chul Han, in his critique of modern achievement society, points out that contemporary performance culture transforms individuals into self-exploiting subjects. When societal expectations demand visible financial success, but structural economic realities deny it, individuals internalize the pressure. The shame of falling behind feels far more immediate and painful than the abstract threat of future debt default. When you open a crypto app, you are not just entering a marketplace. You're entering a carefully designed psychological loop. Behavioral economist Dan Ariely has documented how digitized, abstracted money drastically reduces our natural aversion to financial loss. On a phone screen, 20 million won does not feel like 20 million won. It feels like numbers in a video game interface. Furthermore, crypto exchanges exploit what psychologist B.F. Skinner identified as a variable ratio schedule of reinforcement. When rewards arrive unpredictably, the human brain releases far higher surges of dopamine than when rewards are consistent. A steady monthly paycheck yields a predictable, flat neurochemical response. A 50% price swing on a volatile token at 2 in the morning triggers the exact same neurological circuitry as a slot machine payout. Consider the kimchi premium. This refers to the historical phenomenon where cryptocurrencies traded at a significant price premium on Korean exchanges compared to global exchanges, sometimes reaching 20 or 30% higher. This price gap existed because capital controls restricted foreign arbitrage while domestic retail demand reached a boiling point. Korean young adults were knowingly paying a higher price than anyone else in the world for the exact same digital asset. Why? Because the localized FOMO, fear of missing out, was so dense that the premium felt like a small price to pay for entry into the engine of wealth creation. Now look at what happens when the market turns. The green candles disappear. Red numbers cascade down the screen. The coin you bought drops 40% in 3 hours. What does your brain do next? Standard economic theory suggests you should cut your losses and walk away. But human behavioral psychology operates on loss aversion, a phenomenon pioneered by Nobel laureates Daniel Kahneman and Amos Tversky. Loss aversion proves that the psychological pain of losing money is twice as powerful as the pleasure of gaining an equal amount. To avoid feeling the excruciating pain of realizing a loss, your brain makes an irrational calculation. You do not sell. Instead, you double down. You borrow more. You trade with higher leverage to break even. This is the psychological mechanism behind the debt spiral. Data from Statistics Korea shows that household debt-to-income ratios among Korean youth have reached historically unprecedented levels over the past 5 years. When leverage positions get liquidated, the financial loss is instant, but the debt remains. The mental health cost of this phenomenon is devastating yet largely invisible. In a culture where financial failure carries immense social stigma, young people rarely discuss their trading losses with parents or friends. You carry the burden in complete isolation. You sit at your desk at work, pretending everything is normal while your smartphone in your pocket vibrates with margin call notifications. Here is the counterintuitive truth about high-risk crypto gambling among young adults. It is rarely about luxury cars or flashy designer goods. For the vast majority, it is an attempt to buy back a sense of agency in a world where traditional milestones, owning a home, starting a family, achieving financial independence, feel entirely out of reach. High-risk trading becomes a form of economic escapism. It offers the illusion of control in a system where hard work no longer guarantees security. Now look in the mirror. This is not just a story about Soul or Upit. This is a blueprint of how modern financial apps, social comparison, and economic anxiety operate on the human brain anywhere in the world. Whether it is Robinhood options trading in North America, zero-dated options in Europe, or high-leverage crypto trading in East Asia, the mechanics are identical. Gamified interfaces strip away the reality of risk. Social media grids magnify the success of the few while hiding the ruin of the many. Structural economic stagnation creates a climate where high-risk gambling looks like rational strategy. You are not immune to these forces. Your brain is wired with the exact same evolutionary architecture that responds to variable rewards, social comparison, and loss aversion. Every time you check your portfolio during a social gathering, every time you feel a pang of anxiety seeing someone else's financial win, every time you consider taking a risky shortcut because slow progress feels too slow, you are standing in the exact same room as that young trader in Seoul. The solution does not begin with market timing or technical chart analysis. It begins with recognizing the trap. It begins with understanding that financial wellness is not a sprint against your peers, but a quiet defense of your own mental peace. You open your phone at 3 in the morning, the glow of the interface hits your eyes, you look at the order screen, you check your bank account balance, but this time, you recognize the psychological pull for what it really is. You close the app.